Hi, everyone. Welcome to the HDIN Research 2026 Strategic Insight Session. Today we are examining the global and Chinese cutting tools industry. This report analyzes the structural transformations currently reshaping the industrial teeth sector, focusing on financial performance, high-end substitution roadmaps, and the move toward integrated process solutions. I am representing the Senior Industry Group at HDIN Research. Starting with our executive summary. The industry is at a pivot point driven by a dual upgrade, the rising penetration of CNC machinery and the acceleration of high-end localized substitution. Our data suggests a transition from pure hardware sales to integrated service models. While global leaders like Sandvik focus on digitalization, Chinese challengers are shifting from capacity expansion to efficiency gains. This is a capital-intensive environment where the primary growth engine is now super-hard materials like PCD and CBN. Looking at the global landscape, the market scale is projected to reach $28 billion by the end of 2026. While China currently stands at a 29% CNC rate, it remains the most significant growth engine as it closes the gap with developed nations. However, we must monitor macro factors such as geopolitical trade frictions and the security of tungsten resources, which are driving a China plus one supply chain strategy among multinational corporations. We will now move into our deep dive analysis using the Harvard Financial Framework. This section evaluates the strategic, accounting, and financial health of the industry's Tier 1 players to understand their underlying value drivers. In our strategic analysis, we see a clear bifurcation. Global giants are moving towards selling uptime through digital toolpath optimization. Meanwhile, Chinese challengers like OKE and Huarui are leveraging their positions to capture mid-end standard markets before moving into specialized vertical grades. Our competitive matrix highlights that while technical sophistication remains a high barrier, service-based solution capabilities are becoming the new frontier for margin protection. From an accounting perspective, capital intensity remains a defining trait. Recent spikes in fixed asset investments among Chinese firms have led to significant depreciation charges, temporarily impacting net margins. We also note a conservative approach to inventory valuation and a high ratio of expensed R&D, which speaks to the high quality of earnings and the rapid iteration of technology in the 3C and automotive segments. The DuPont decomposition reveals the different routes to ROE. Specialized players like Xinxing and EST Tools achieve superior returns through high net margins and swift asset turnover in niche markets. Conversely, larger players in the capacity expansion phase, such as OKE, are currently navigating the J-curve, where heavy investments precede long-term profitability. This reflects a strategic trade-off between current dividends and future market share. Examining global operating indicators, Sandvik and Kennametal maintain robust gross margins above 40%, supported by vertical integration and high recycling ratios. The strategic focus for these giants has shifted decisively toward ESG and, circularity, with a goal of 90% tungsten recycling to mitigate resource volatility and lower carbon footprints. In China, the landscape is evolving. While revenue scales are smaller compared to global peers, firms like EST and Xinxing show exceptional net margins in specialized niches such as broaching and hole processing. We are seeing a move away from single product substitution toward high-value comprehensive solutions as R&D teams grow in both size and sophistication. We now move to global market comparison and geopolitics. Focusing specifically on China, the old for new equipment update policy is a significant tailwind. As the nation targets a 75% CNC rate by 2027, the demand for high-performance inserts will grow exponentially. Our research emphasizes the importance of supply chain security across all UN-recognized regions, ensuring a stable domestic foundation for industrial growth. Geopolitical factors remain a primary risk. China's control over 60% of global tungsten reserves provides a structural cost moat for domestic firms. However, export controls on high-end equipment like MPCVD accelerate the need for domestic technological breakthroughs. Companies are responding by regionalizing manufacturing to bypass tariffs and investing heavily in, value routing within localized technical centers. Our product segmentation shows cemented carbide still holds a 63% market share. However, the most dynamic growth is in the super-hard category, driven by the unique requirements of the new energy vehicle and 3C sectors. We also see a notable shift from traditional high-speed steel to powder metallurgy as the new standard for complex cutting tasks. Downstream demand is being redefined by NEVs and humanoid robotics. Electric vehicles require high-efficiency milling for aluminum housings, where PCD tools dominate. Looking further ahead, the precision gear requirements of the robotics industry represent a, quote, blue ocean for complex broaching and gear hobbing technologies projected to scale up significantly by 2027. Sustainability is now a competitive necessity. The product material product, or PMP cycle, allows firms to decouple growth from raw material extraction. By achieving high recycling ratios, companies like Sandvik and Mitsubishi are not only reducing CO2 emissions by up to 40%, but also securing their supply chains against global market fluctuations. To conclude, our roadmap to 2030 anticipates 3 phases: consolidation in 2026, value rooting in global markets by 2028, and a move toward global dominance in high-end sectors like aerospace and medical ceramics by 2030. The industry winners will be those who master the cost per part metric through digital optimization. Thank you for your attention. For more granular data or custom research reports tailored to your specific market needs, please reach out to our team at sales@hdinresearch.com.